If you've been watching the market the last couple days and you think to yourself, what in the actual shit is going on? I can tell you right now, nobody has any real idea. But what we do know is that Bitcoin is having a bad week. We're going to spend some time looking at the charts today. We're going to get into the market status, the synthetic volatility index. We are actually in a broad market rally. I'm going to explain it to you in all under 1 hour. We're going to check the public sentiment, and I'm going to tell you who's full of shit and who's not in the markets. And anybody who tells you they know why this is happening is likely going to be on the full of shit side of the spectrum. That being said, we got a lot to get into and not a lot of time. I'm using the yellow Chiron today because it just seems like when the Dow's about to hit 50,000 for the first time in history that you got to have some color in your life. So we're doing that. So for all those of you who are new to the show, you can leave comments, you can chat, I can bring you in. I can do it not only vis-a-vis this bad boy over there, but I can also do it in a different, couple different formats where we can actually talk and look at things and have a little more of an aesthetically pleasing conversation. And for those of you who said you couldn't read it last time, it didn't look very easy to read. We added a little bit of texture to the background here and upgraded this a little bit so we can see the comments and where they're coming from a whole lot better. And we can also feature you in the show. For those of you who are on the YouTube side, like my guys Saeed and Sean, feeling good about my moist hands right now, though. I bet you are after a 50% rout. And as Saeed notices, trying to say squarely reference the FOMC's classic opening line, we got a wild day ahead of us. And I will apologize right now off the gate. My first chart, I believe, for those of you who know the markets, you guys know that the market has not been crazy wild. So I haven't had the opportunity to see how this does not look aesthetically good in a broad rally in a true bull market like we're in today, because we haven't had one since I created all these charts. But as a reminder, we are looking at the ETFs as proxies for the indices, all of which are glowingly positive. Keep your eye on the Dow Industrials. We're about to hit 50,000 right there. And we are seeing a 1,000+ point market rally It is a gloriously positive day. We are way, way to the right as far as a broad market rally goes. Whenever I created this, I didn't think this day was going to be anywhere near soon, which is why I never tested the formatting on these cells. My bad. So we are in an officially in a broad market rally, and I'll be honest with you, nobody has any fucking clue as to why. I think this combined with the sell-off that we saw in cryptocurrency and Bitcoin has made for a very strange dynamic. I'm going to explain it all to you thoroughly, what we do and what we do not know, which is likely to be at least in part behind this. But what you're going to hear is that we are effectively in one unique type of market for crypto, and that's going to be what's defined as a risk-off market. Remember that language. We're going to talk a lot about that. Crypto is going risk off. So where is the risk on going back into? A true bull stock market. And yes, crypto impacted stocks are having a bad day, but everybody else, which is largely the biggest part of the market, is having a good day. Strange dynamic. I thought it was going to be the Epstein conversation which really kicked this off and which got this started. It doesn't seem that that's the case. We'll spend some time looking into it, but there's also a magic number before we get into the show you need to be reminded of. 70,000, 70K. That is where if cryptocurrency falls below 70K, it costs more to mine cryptocurrency, i.e. Bitcoin, than its value. So it becomes economically unviable at that point. We saw it drop below that just recently. So if anybody has any questions, now's your time. Okay, so in this comment here, I'm going to go to this real quick because I think this is important. Maybe so. I can't imagine that was the bottom crazy last couple of days. I can't imagine that's the bottom either. Dead cat bounce, brother. Dead cat bounce. Sometimes a dead cat will hit the ground. It'll bounce back up. Looks like it's alive because they got 9 lives and then they just stay down. So I think that could be, in theory, what we're seeing here in the markets. And I think that largely because nobody understands why this is happening. And if somebody doesn't understand why it's happening and all these people are going to go back and invest in it, I understand why we got a bounce from 70,000 or from below 70,000 back up to about 70,000 where we're at today. We've seen some recovery in Bitcoin, but that's because they need to cover ETFs and everybody else need to cover the cost of actually mining these damn things. They've gone largely risk off. I even asked ChatGPT because I didn't understand it, and I was like, "What the hell's going on?" And ChatGPT is like, "Bruh, I don't know." So let's start off the show in an unorthodox way. I'm gonna get back to our market status chart. Let's go over here to a screen share real quick. Let's jump into Bitcoin. It is still below 70,000, sitting around 69,904. It's been a little bit fluid up and down around 70,000. Again, that 70,000 marker, like I told you about, is real. It is impactful, and you need to keep your eye on it. If we fall and stay too far below this for too long a period of time, everybody who's anybody in the cryptocurrency, Bitcoin heavy space is going to get kicked royally in the ding ding as margin calls and risk off continues to elevate. But before we get back into all of this, we got to go through our usual rhythm. Market status. We are in a true bull market. Remember, keep your eye on this bar here. It's going to tell you what the status is as we go through the rest of the sectors. But let's, before we jump on that, go through the synthetic volatility index. This one was a bit surprising to me. There is fear in the markets. We've seen a palpable shift from a calm market to a normal market. But this is where this type of analytics really thrive. You're seeing a lot of volatility. You're seeing a hyper positive spin up 1,000 points in the day. We're hitting 50,000 in the Dow is an all-time high. We haven't seen an all-time high in the markets like that for several years now. So this is a very interesting day. You would think that this would be all the way calm, totally positive, up 90. We've actually seen this drop down. We started 2 weeks ago at above 90 or around 90-ish, and we saw it drop down to about 78 today. With the last couple of days, we've seen it in the mid-80s. So we've seen volatility creep back into the market. This just tells me that you're seeing a risk-off position of crypto back into the stock markets. There is a quote asterisk here. These software developers are really getting displaced by cryptocurrency, not cryptocurrency, by AI. See where my head's at? By AI. So you're going to see a palpable and distinctly different landscape in some of the macros, and we're going to cover that in the sectors a little bit here. Let's go to liquidity. This has not improved dramatically, but it has improved slightly. The Fed balance sheet is still flush with cash. Fed repo, treasury accounts are still being utilized. Net liquidity level is low, but we have seen some improvement. We have a restrictive liquidity, so extra cash into the markets is not coming from the Fed and their activity. Extra cash in the market seems to be coming from this disposition of cryptocurrency, and that seems to be where all the money's driving back into the markets from. Maybe this is a lack of confidence in Bitcoin. Maybe it's something else, but we're certainly in a risk-off position in crypto. So let's go to the Housing Affordability Index. Again, no changes here. We're still at a very unaffordable housing market. Today's story is not housing, so I'm not going to spend a whole lot of time on it. You know how much I love this. We got housing supply, but we're still strained due to affordability levels. I'm going to leave that there and move on to what I think is a more interesting segment for today. Let's go to the calendar. All right. Non-farm payrolls, unemployment, and Michigan consumer sentiment all today. GDP, however, came out, and we saw GDP with an 8% number. We haven't seen GDP that strong in a very long time. Look out next week for some inflationary numbers. Look out for some of the stuff that didn't come out this week because the government shut down to come out next week. I think that's going to be really telling as far as some of the employment numbers and figures there. But certainly we saw some healthy GDP figures, and I think that's kind of falling in line with everything else here. Now, this is where the sexy starts to happen. Let's talk about the sector. I'm not going to, again, spend a whole lot of time on the housing sector and rate demand. We've seen these guys. It's a bit of a mixed day here. We're still in a broad market rally, but it's certainly not because the housing guys are leading the way, right? We're going to find out who's leading the way and why, though, together, collaboratively, as a team. You and me. Us. All right, let's look at the banks. The banking sector is having a good day. Look at that. I have long said that the KBRE, the KBE, I think it's the KBE, the KBW's banking index. These guys are going to have a good year. They're going to see a lot of M&A activity in the banking sector, tech, banking in particular. A lot of the Dow industrials, I think they're going to start to have some growth, particularly as some of this tariff stuff does bring some manufacturing back to the U.S. But don't sleep on banks, man. Both regional communities, if you want some M&A upside and potential deals that are going to get announced, and certainly as we start to see money from cryptocurrency exit and go risk off, where's that money going? I'll give you some ideas. Where do you think it's going? It's going into the banks. That's right. So it's not the Fed. We've seen that. We took a look at the Fed liquidity pulse. That is directly from the St. Louis Fed this morning. So that is not legacy data. That is not my opinion. That is just purely metrics driven. So you're going to see the banks continue to drive there. The CRE sector, where there's commercial refinancing risk, it's somewhat negligible. So this is not having an impact on the market today. We have not seen meaningful change in this market in recent days. I'm going to save the mega caps for the sexy part of the conversation. The industrials, however, are having a good day. Caterpillar, Deere, General Electric, Union Pacific, 3M. Again, industrials, Dow leading the way. We're seeing Dow almost about 50,000, so it should be no surprise that you see a really, really good day in the industrial sector. The real economy seems to be growing. This coming on the heels of that 8% GDP number that came out. I think that's going to effectively be just pimping the economy hard. You know I'm a fan of energy. Energy also up. A lot of the things we talked about on the show, this is the proof of concept. We said banks were going to go up. We said you're going to see real economy Dow go up. And we said you're going to see it in the energy sectors. You're seeing it in this broad market rally, a true bull market. The defensive stocks shouldn't be as glorious as they otherwise would be in a risk-off economy. And that's exactly what we're seeing here, a relatively muted day. Now, two more to get to, and we're going to spend some time on these two. Number one, consumers also growing. GDP seems to show the positive, but I would like to point out you're not seeing a massive influx of spending in the consumer market. Walmart, Target, Costco, Home Depot, and Dollar General having what I would call a moderately good day. Not like sexy, but moderate, you know? Let's go to mega caps. Let's see it, kids. Yeah, this is not a mega cap rally, okay? That's going to surprise many people because we even ourselves, we put a tech-led piece in this part of our equation because tech has led the way. The Mag 7 has led the way, leading the S&P 500 for so long that we forgot that people outside of tech can perform. And it's happening right now. And I love it. I'm here for it. I'm all about it. So let's spend some time talking intimately, eye sockets to eye sockets. You need to expect that as crypto continues to sell off, this money's got to go somewhere. Where is it going to go after it pays down debt, some of which is leverage, and I'll explain later on in the show what that looks like and why that's scary. But the money's going to go back into the markets. And they're going to go back into things they feel is risk off. They're going to go risk off in speculative crypto, risk on in Dow industrials. They're going to go into the banks, okay? Look at banks, both from community regionals and the large banks. They're going to be profitable as their net interest margins widen. Their profitability is going to grow, particularly as the long end of the treasury continues to grow. That's going to happen. Energy, whether we like it or not, crypto is, I keep doing crypto. AI is going to need energy and power. We are in a tech-focused world. Even if AI doesn't get the lift that we think that it's going to get, every single time you go up in models, and we just had models in both Anthropic's model, Claude, and you saw ChatGPT release their newest models just out, I think it was yesterday, 4.6. Those all require sizably more power and are incrementally more efficient than the predecessor model. So you're going to see energy needs continue to rise. That's a real thing. And of course, I think the industrials, good old fashioned American workers, are coming back, baby. And I think that's where the money's going to go. Crypto into this space. And of course, the industrial also gets the benefit of banks and energy dumping money into the industrial sector because these things got to get built. These things got to get built out. The CapEx spend. A lot of these mega caps that we saw earlier, Nvidia, the Mag 7, they're putting a ton of money into capital expenditures, which means they have these assets now. They have to turn profitable. They have to get a return on investment in these things, and that's going to be a big problem for their profitability in the near future as these other sectors continue to rise. So, I'll pause here. Go to the comments. Are you on YouTube Live? Yes, I am on YouTube Live. We are streaming across multiple platforms. We're streaming on YouTube, X, LinkedIn in horizontal format, in vertical format. We are on Instagram. TikTok kicked us off. Apparently, TikTok doesn't like highly produced content. So if you don't have video shaking, they don't want you there. So they gave us a warning shot across the bow, basically saying if I'm not using a mobile phone, they don't want me. And I was like, fine. I don't want you either, dog. And we got off TikTok. So only vertical format right now is Instagram, and it is much easier to view the show, particularly the charts and some of the analytics that I'm going to bring up here in a wider format. I recognize that it's harder to see, but we thought this would be a good point to capture people and bring them into the show. Let's go to the comments here on YouTube. Also, Finance World will do better with the analogies. Let's see what we got here. My guy Sean, also there is something in the big beautiful bill about 100% tax depreciation on CapEx. Yeah, we'll see how that plays out. I don't think that's really causing a negative for the market right now. I think this is all about risk off today. Sorry, taking myself a little time with a beverage, getting some intimates. All right. Let's go into my favorite chart. I like the XAI modeling that we put together. Again, if it's on this side of the charts, this is all data analytics, all coming from algorithms and from raw data. Think St. Louis Fed, think stock market real-time pricing like you see down below. This over here, everything you see on this side is going to be social media and AI driven. This is our trending now analysis. We go to these charts to show you what's happening in the world. We're looking at Instagram and we're looking at X. Obviously, this is a pretty simple and known thing, but one of the things trending topic-wise on X right now is the Bitcoin rally above 70,000. Let's see what AI has to say about it. Bitcoin surged over $10,000 in less than 24 hours, reclaiming $70,000, with ETH also gaining over 10% on the day. Ethereum. This is, of course, a 450% spike in mention. We're seeing elevated risk and a sector impact in the cryptocurrency space. What does AI have to say about it? Dramatic crypto recovery suggests institutional FOMO may be driving prices beyond fundamentals, creating potential for equally dramatic reversals, i.e. the dead cat bounce. Now, before I go on to the other headlines here, let's have an intimate conversation where I give you the side eye. Okay, so the way this works, and unfortunately I've got way too much knowledge on this, and I wish I didn't. What crypto firms, particularly Bitcoin firms, did is they went to the markets and they said, hey, look, we want to leverage our holding of cryptocurrency that we're buying with other people's money. So people will invest, they'll buy cryptocurrency, then they want to invest, and they want to leverage that, get a loan on it, on LTV, a loan to the value of the actual Bitcoin, and then buy more Bitcoin so they can get more upside appreciation and then return more to their investors, netting out the cost of actually financing this. This is very risky. And banks, and particularly the regulators, didn't like this. So what happened? Well, they said, okay, we're going to lower the loan to value to something that's more palpable. They're going to say, you know what? We're going to say, hey, give us 50% in cash for every Bitcoin we give you in collateral. And the whole collateral thing, where you're going to collateralize a token, requires usually some type of cold storage and extra level security. That's a different topic for a different day. But there are some banks who did this. And they said, okay, you know what, company? You're taking all this investor money. You're buying all this Bitcoin. You take this Bitcoin, you want a loan of 50% against the value of that. We'll give you the loan against 50% of the value of that, and then you can go out and make more money on the upside. You can see how this could have a cascading effect for two more important reasons than just the fact that you're leveraging something that really isn't yours. It is, number one, the fact that if you have leverage on something and it goes down approximately 50%, keep in mind Bitcoin was at approximately $126,000. It is now currently around 69K. So if you lose almost 50% of your value, you're already at what we like to call in the industry a margin call. Margin calls, for those of you who don't recall, are bad. Bad, 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 bad. As a matter of fact, that's actually what drives the market down during most stock market crashes is people have leverage on stock and they get called. They have to pay that stuff due and payable, and those margin calls are very problematic. Hence the risk-off position in the market. The other reason why this is important, anything below 70K, it costs about 70K to mine a single Bitcoin. If it costs more to mine than it's actually worth, you've got a losing money model. Yeah. So the natural question is Chris, well, why is Bitcoin surging? Nobody really knows. That's this whole weird influx. And I'm going to bring this up so we can talk about it while we're looking at it, because it is going up and down, back and forth to 70K. Look, nobody really knows. I even asked ChatGPT, which is not something I usually do for financial sector stuff, but I'm gonna tell you what it said to me, and I'm gonna explain to you why I think it's actually right, but it kind of wild that this is where we're going here. So, said risk off macro is back in charge when markets get jittery, rates staying higher, growth scares, big tech volatility, which sounds like this market. Investors tend to dump high beta, meaning assets that can change up and down in price a lot, assets first, crypto included. Reuters and other markets coverage describe this as a cross-market deleveraging risk-off move that's also showing up in equities and even some commodities volatility. So it makes sense when you think about it on the spectrum of risk that people are saying, okay, if crypto is up here in the risk profile, stock market's down here, and cash is down here, right? We know that cash loses money. This is not a viable option. So we're going to sell here at crypto and we're going to go into the stock market. And guess what? You wake up the next day to a broad market rally. That makes a whole hell of a lot of sense. The question is what spooked the market into going, you know what? I'm not going to put my money in crypto. That shit's volatile. Because that's what's really happening. And nobody really knows that answer. Of course, I also asked ChatGPT about that because, why not? Leverage got flushed. A sharp drop triggers margin calls. Forced selling pushes prices lower. That triggers more liquidations, a classic domino effect. Recent coverage cites $1 billion in leveraged liquidations during the slide in the last 2 days. ETF flows slipped negative. Spot Bitcoin ETFs can act like a constant bid when they're taking in money. They start bleeding it and remove support. Technical breakdown, sell the rally behavior. They're talking about consumer behavioral economics. I'll tell you, I think much like some of the comments that we've seen here, that there is a potential for something to happen that we're seeing right now that I want to be very clear about. Inevitably, someone will say, well, it's at a low. It's got to go up from here, man. And I'd say that, I get it. I hear you. I am worried about dead cat bounce. So here's what has happened in the stock market before without cryptocurrency, but cryptocurrency is no different here, is that you've got algorithmic trading. You've got a lot of institutional investors who are going to buy and sell cryptocurrency throughout the day, throughout the weeks, months, and years based on algorithms. In some cases, probably using AI. I'm not aware of any, but I'm sure they're out there. That being said, what's going to happen is they're going to say, okay, we've lost 50% of the value. Now's the time to buy more, which in effect stops this free fall as people start buying more, right? And they go, okay, well, we've hit a floor here. It's going to go back up. But I don't know how that happens if we are truly in a risk-off environment and people are going into the stock market. We're seeing this cash dump into a true bull market. Then that money isn't going back into cryptocurrency, into BTC. It's going into the stock market. And if it's going into the stock market, okay, that money isn't going to come back in any meaningful way that it did, because the investors that believe that this is coming back isn't going to happen. The other part of the problem is algorithmic trading. The algorithms are saying, okay, we're at a low, here's the trading volume, here's the frequency, here's what I think it's going to go back up. The algorithms might buy more, but what ChatGPT, ironically, and as sick and twisted as that is, alluded to, there's a behavioral economics play here. Retail investors do move the market. There's a ton of retail people like you and me who are buying cryptocurrency. Unless they have a reason to believe that it's going to go back up, i.e., momentum, I don't know that they're going to go back into this. They might follow the institutional money, which is back into the stock market. And you don't need to look any farther than the current status of the market, as ill formatted as it may be. We are in a true broad bull market rally, and this is telling you clearly where the money is going. And I just want to say for the record, Saeed and I told you this was going to happen. We told you it was going to be bank stock sectors. We told you it was going to be energy. We should have charged for that. Saeed, if you're watching, we're terrible at our jobs. We don't. As ironic as it is that we tell people where the market's going, we don't make any money telling people where the market's going. What's wrong with it? Anyway, whatever. We're idiots. But let's go back to the sector here. Again, the sectors are going to be really telling. I think that these are exactly what we thought they were going to be. Looking particularly at, let's look at banks. Sorry. Banks are still up, right? Consumers are still up. Industrials still up. That's where the money's going. The industrials are heavy. And this one, to me, is so good for the economy. Love or hate the current administration and their policies, this is a great swing for what the tariffs and the argument. So let's take a pause here and do a little more sexy conversation. Then I'm going to get back into the XAI stuff. We got some more market headlines to cover. So one of the things that I'm often criticized about from an economics perspective is that I say stuff like the tariffs are effectively a tax on the American people that will act as a stimulus package again if Americans, and we hit 50,000. We officially hit 50,000 for the first time in the Dow. This is nuts. Nuts. And you know what? I feel like this deserves a special headline. What do you think? I think Dow hits 50K for first time. That sounds. And there you go. Look at that. See, we even got motion in the Chiron there. And look, I'm even using industry vernacular like Chiron. So I often get criticized on the tariff conversation, but the whole point of tariffs is it's supposed to put pressure to manufacturers to bring manufacturing back to the United States, create more manufacturing jobs, and help the economy. That really only happens if tariffs stay in place and stay elevated for a prolonged period of time so that you can get that investment back in the economy. That was the original pitch, I think, going back to Alexander Hamilton's period of time. That being said, it's a big question mark when you take the tariffs off if people are going to follow through with some of these changes. And we also have the changing landscape of AI and jobs and some of that stuff from the market. So I don't necessarily know that tariffs are going to work the way they should in classic economic policy. As a matter of fact, what we're telling people a lot about on the show is that it's not going to function that way. But certainly when you see the sectors performing like we've talked about in the show today, that there's some meaningful benefit that is inuring to society. Now, whether that's because of this whole crypto sell-off and people want a different risk profile, maybe. Or maybe it's because you got the Epstein list that came out. And in that list, he talks about having the 5 developers' names and referencing the 2 lead developers by name and saying that he, vis-a-vis foundations, had invested money in the crypto nonprofit. So maybe there's some of that, although I haven't seen anything to suggest that, but it certainly made me feel all weird and just strange about cryptocurrency in general. So I don't know. I mean, I really, really don't know. And nobody, even AI doesn't know what's going on in the markets. But let's go to the comments. Who's out there? Let's see what we got going on here. Saeed. Oh, wow. I'm getting a lot of here in the comments. Let's go over to first to YouTube here. No, there you go. I'm hearing Gemini Exchange is closing and moving to Toro in EU. How will this affect price of crypto? As of right now, it's a big question mark. It's unknown. I think people are really afraid of legislation and regulation in the United States, but we've seen such mainstream adoption from ETFs. This was likely put in play long before that, particularly when you layer this into things like prediction markets and poly markets, which are becoming much more pervasive. Think Kalshi, think poly market. Poly market does power our bar down below. I don't know that this does anything to change the landscape as it relates to crypto in general. I think that is not feeding anything that we're seeing today. I think that's more of a long-term move. And the same thing can be said for what's happening in Texas. Texas has their own stock market they're opening up. The New York stock market, New York Stock Exchange is not exactly happy with that, but it hasn't destabilized the market, and there's structures put in place to ensure that it doesn't. So I don't know that that's going to be a meaningful impact to anybody else. If anything, it's just trying to get away from regulation and do things their own way. So I hear what you're saying. I'm watching it, but I haven't seen anything meaningful as of yet. Sean, just saying, is BTC a productive asset? That depends on how you define productive asset, right? The whole promise of cryptocurrency was this decentralized set of circumstances, which I don't know that we're technically seeing quite the same way. So again, we will see, and we'll figure it out. But as of right now, the biggest value to me has always been the blockchain, not necessarily the value of the currency. I can tell you right now, whether you think it's productive or not, I can tell you clearly it is perceived to be riskier based on what the market is telling us today. Not my opinion, just what the market is telling us today. Anytime you have an asset that can swing 50% in price in a matter of days, weeks, or months, okay, you got a problem. And the problem that I have with that volatility is I can't point to a single, I guess, tactile reason why, and that's a problem. Of course, there is the proponents that are enjoying this view. Said Omar, you're welcome. Yeah. Crypto haters, it's Saeed at higherstandardpodcast.com. And crypto lovers, send them something nice. You know, maybe a virus. He doesn't check the email anyway, trust me. Okay, so let's get back into some of the XAI stuff. I think XAI stuff is important here, and I think that the other market rhetoric is valuable, particularly because we're in a real true bull market. We had seen a little bit around NVIDIA and OpenAI's relationship. NVIDIA CEO Jensen Huang addressed tensions with OpenAI, stating there's no drama, but emphasizing OpenAI's dependence on NVIDIA as new generational chips. AI's insight here after this 280% spike and risk profile of moderate impacting tech. Huang's defensive tone suggests underlying AI partnerships. Ooh, interesting tension that could create supply chain vulnerabilities for both companies, which is probably why you've seen their stock take a bit of a hit in the last couple of days. And for those of you who haven't been following the stock, don't worry, Daddy has. Let's go to NVIDIA and NVDA, I believe, and let's go to the stock chart there. NVIDIA Corp, there you go, 4.43% up today, but over the course of the last 5 days, let's take a look. Not so sexy, huh? But for those of you who are familiar and like our outcome forecast model, let's take a look at what that says, okay? And I will, again, tell you that the outcome forecast model is a Molotov cocktail of sexy we put together. It takes not only AI, content, streaming, rhetoric, behavioral economics, and real true data to give you an idea whether this is an actual good trade in today's market. We have a very strong market, very strong bull rally. The macro factors are still somewhat questionable, and they're really pointing to the liquidity pulse index. Liquidity is draining from the system, but what this model does not take into account is that liquidity is draining from cryptocurrency going into the stock market. So I don't think this is a negative at all, as a matter of fact. We've got the overall market seems to be about a 78. We got NVIDIA has got price momentum. Synthetic volatility shows that we're still in a healthy risk perspective. So this is saying, yeah, if you want to do that, invest. It's trending in social media right now. What you should buy are not options. You should buy shares. And this is a swing investment if you want to do that. The risk level here is moderate, but it's certainly not elevated. So this would be a good investment in the long term, according to our outcome forecast model. And somebody inevitably is going to be saying that like this on X or something and go, you needed an outcome forecast model to tell you that? Yeah, this is probably an obvious outlier that is a clear choice on a really, really good broad market rally day. But we're testing to see the model works in all circumstances, and this one, it tends to work. So suck it. All right, let's get back to XAI. I think this is an important part of the dialogue here. I'm going to clear this forecast and go back down to XAI. We also have a Wall Street recovery, which we've been talking about the entire show. Major market bounce after tech rout, with Dow surging over 1,000 points at this point to 50K. Though some tech names like Amazon still under pressure. I think the Mag 7 has been overinflated. People are worried about a bubble. And you think about this in the human element, here's what's happening, okay? People say, if it's true, they're saying crypto volatile, we want to go into stable assets. You go into industrials, you go into the risk off assets. And right now, if you think there is an AI bubble, or even that the rhetoric of an AI bubble scares you, you go into the assets that you know are less AI impacted and much more stable. You go into the industrials, hence the Dow hitting 50K, which is industrial driven. Sharp reversal patterns in tech suggest algorithmic buying. Same algorithmic buying I'm worried about on the crypto side. If we hit that flat floor of 70K and we're going to start the pulse back up, I'd be worried about another drop below 70K because of the risk off position. And I'd be watching what's going on in the stock market as well as the crypto market, because that's how the money is going to play off one another. Artificially inflating recovery strength before the next leg down. And what this is basically telling you, AI, ironically, is telling you vis-a-vis this AI-driven analysis of social media rhetoric, again, pulling from Instagram and from X, it is basically telling you that it is concerned that the recovery that we're seeing in, or the stability that we're seeing in the AI stock sector might be fragile, might be algorithmically done. This risk off position that we're seeing in crypto into this might be the start of what could be a healthy Dow pickup. Now, I like this because this means that there's going to be more jobs for Americans, hopefully, combined with the GDP number. Maybe this means we can get some wages. But when you think about it in the context of you got companies at an all-time high, but then redeploying that capital and the capital expenditures, CapEx, and not distributing it in the form of dividends, you wind up in a set of circumstances that are going to be unknown. Okay. China is also having a crypto crackdown. So for the people who asked about the EU earlier, why they're not going to China, the obvious answer is likely this. But China banned unapproved yuan-like stablecoin issuance overseas and restricted Chinese entities from unauthorized crypto issuance abroad. China's overseas crypto restrictions signal escalating regulatory war that could fragment global crypto markets and reduce liquidity, which is why I said earlier that the move from Gemini to the EU is likely regulatory driven, because they're seeing if the superpowers, i.e. China and the US, are having these crackdowns and trying to do some of these things, that could be a safer future for them in the years to come. Of course, there are some more headlines here, but nothing that I think is super valuable at this point in time. I'm going to cover one more. I think ETF flow acceleration. Accelerating inflows into ETFs while outflows from human managed funds continue. Highlights the ongoing passive investment trend. If you've been following the RIA space, which I spend a lot of time following, the registered investment advisors, these are very sexy on Wall Street right now. Every private equity firm wants to buy an RIA. Everybody wants to have access to these individuals who've got a lot of money. And because of that, you've seen a lot of money go into the asset management space. ETF flow dominance creates price discovery inefficiencies. So basically all these RIAs, in order to be more efficient, and they think it's better for humans to have less humans and more AI-driven analytics. You could have investment advisors and humans making decisions, or you could have analytics and systems and programs making the decisions for you. So that's what they're seeing, is they're seeing a bigger flow from out of human managed funds into ongoing passive investment funds. And I think that's likely to be a trend to see in the future, particularly if you start to get more return in the markets and the industrials, which means that you don't have to take as much risk in the markets to get a better return against inflation. Make sense? All right. Well, that was a lot in just 38 minutes. Anybody on Instagram have any thoughts, comments? I am watching you guys. I'll just say hello real quick. Hello. There we go. Meanwhile, I'll pop back over to the other combined chat. And as a reminder, I don't get Instagram in the combined chat, so I can't pull you up on screen here, but we are going to spend some time. I feel you, the blockchain and possibly stable coins will be the more important part. Yep. Arun, wow. Look at this shit. I can't believe it. Arun, the original DJ Arun in the house. Love you too, brother. Surprised you're actually, I don't know what channel you're on, but you know what? Hold on a second. Now I'm just morbidly curious, because you never tune in, my guy, and I'd love to see you here. So let's see what you got here. Arun is, where are you? Huh. There's too many comments. I can't see you. But Arun's in the building. I love it. We love you, brother. Welcome back. It's been a long time. Maybe you should come help me during the lives. I'm here by myself, man. It'd be nice to have, you here. That's all I'm saying. Okay, so let's take one more check of the market real quick in market status. We're still seeing a broad rally. There hasn't been any meaningful change. I think we're still in a very healthy economic position here. Let's get into some of the sectors real quick, make sure they're still holding up. They are, in fact, holding up. So I think we're pretty consistent here. Banks are still going to be wildly positive. There's going to be no pivots there. We're still going to see it in the consumer side. We're still going to see it in the energy side. Yeah. And we're still going to see it in the industrials. Wow, what a broad market rally. Okay, well, let's do what we love to do on the show. Let's get into the socials. Let's oh, and I probably should share. We are still seeing Bitcoin there at about 70,000, so we're still on the healthy side of the spectrum there. All right, let's spend some time going over the X rhetoric. As much as I like AI doing some of this stuff, I do think it is better to have a fresh scroll down, if you will, of AI. Let's get into the social view here. Lance Lambert, the average 30-year fixed mortgage rate today, 6.15%. Same day last year, 7%. So for those of you who wanted to see price improvement in the interest rate environment as part of the affordability solution, you are in fact seeing that. Let's take a look at the broader chart that he's presented here. This is your 30-year fixed mortgage rates, 1 day, 1 week, 1 month, 1 year. We are at a 52-week range close to the low here. So again, this is where people are talking about how interest rate cuts aren't going to really be a meaningful part of our future here. You got all of our products are down there, but yeah, I mean, look, if our 52-week low is 6.01%, right? And we're currently at 6.15. We're near the lowest we've been in a year. I mean, I don't know how people can be really upset about that. You know, that's a pretty good mortgage rate. Again, as a reminder, 8% is your average historically. So you're still well below that. And I think that's something to be positive about, depending on how you like it. Logan, my favorite housing bull here, total housing inventory. Yeah, I'm going to go ahead and disagree with this because I don't think this is accurate, because I think the problem is you don't have as many buyers. So inventory is relative to buyers. It's the supply and demand argument. I will give him some credence here. He's looking at total housing inventory. The problem with this is, if you look at this chart, and I'm sure if Logan were ever to watch this show, he doesn't because he hates me. Here's the problem, right? This is 2005 right there. This is 2010. This gray area here is the great financial crisis. So of course you had a bump in inventory in that space there, okay? That is likely, normal, right? Now, this is 1,000 units, right? This is 3,000 units. So really, we've been in and around the 2,000 unit space right there, total housing inventory, right? So and these are in, well, I should say in millions. So these are the number of units. I don't see this as a big of a delta. This is where charts can look really ominous and dark, and I see where he's saying that housing inventory is down, supply and demand, we need more housing. I don't think so. Yeah, I disagree. I think we don't need more housing because the builders got smart. After the great financial crisis, all of their money was tied up in properties they built they could not sell. So they just didn't overbuild properties, right? It's simple business strategy, right? And if you have, I don't know, this problem right here, where the mortgage market is strained, according to my data, and I have the same data he does, supply constraint is not the biggest part of the problem. It's a small part of the problem, but it's not the biggest part. The biggest problem is payment pressure. Well, we just covered that rates are at 6.15%, right? And the lowest they've been in the last year is 6.01%. So that is about as low as we're likely going to get. We're not going to get super low, much lower than that is my likely guess, particularly as treasuries continue to rise, as long-term confidence comes back in the market. So you really got only a couple choices. Wages can go up, home values can go down. And I hope that wages go up. I hope that wages come down incrementally. We hope that housing prices come down incrementally, maybe small amounts. And maybe we keep rates where they are, and that solves a little bit of the pressure problem. But frankly, the only future I see for the housing market right now is a long-term, prolongated correction over time to where all these metrics, your wages, interest rates, and home prices all improve incrementally, slowly over a prolongated, painful amount of time. Unless there's a catalyst. And again, I'm saying this on the heels of this cryptocurrency correction or pivot or whatever you want to call it, that seemingly has a starting point that we don't really truly understand either. So something like that could absolutely happen in a market like this. But unless all those things, and for cryptocurrency, it's a much easier fix, right? You just sell off and you go into the market. For homes, there's a lot of red tape and logistics and paperwork in between here and getting to a solvable problem in a future set of circumstances. So don't get too confident or hopeful on that one. Let's go back into X. Let's do my usual scroll. Darth Powell, home relistings explode higher. People are starting to pen up supply. It's coming back on the market. People are listing their properties. So again, here you have Logan and Darth Powell, very conflicting ideals in the housing market. And this is why I say the housing pundits and fighting at X are a little strange. I got my opinion, they got theirs. I don't know that anybody's right or wrong. They just have certainly a lot of data which can be spun in a lot of different ways to support it. I personally believe, in the data that I'm looking at, pulling straight from the St. Louis Fed, seems to suggest that the supply is not the issue. It's the affordability. John Brooks, also housing. That's a lot of underwater cars. 36.1% of auto loans were underwater at origination. Holy shit. I mean, obviously you drive off a lot. In the fourth period of 2025, not after depreciation, not after downturn, the moment the keys hit the driveway. Oh, God, that's ugly. But let's look at the chart. Yeah. There you go. Percentage of loans originated with LTVs above 100% underwater at origination by trust vintage. There's a couple different ways this can happen. Number one, as soon as you get in the car, you're now selling a used car versus a new car. That's problem number one. It's probably the most common. Number two, people are taking the old financing of their vehicle and layering it onto their new car payment. Some lenders will allow you to do that. But this is an ugly period of time where if those cars are all underwater at origination, that's an exponential curve, as the kids say, and what goes up must come down. But certainly, this is a pain point from an economics perspective, and I would say that auto loans are showing signs of weakness that I've read and continue to follow up on and view. Let's go down here, one more chart. Amy Nixon, Americans are abandoning their financial goals in record numbers. Yeah, we see this a lot on the show. Nearly a quarter of Americans have given up on ever getting out of debt. Nearly 20% have given up on ever owning a home, because the average home buyer age is now 40 years old. That's a problem right there in and of itself. But shares of Americans who say they have abandoned each goal, right? Getting out of debt, 23% of Americans have abandoned the goal of getting out of debt. Building an emergency fund, 23%. And improving my credit, 23%. That's the saddest one. Of all these things, improving your credit can probably be done the easiest, because getting out of debt, which is part of improving your credit, but certainly it's if you could get out of debt and improve your credit, even incrementally, not fully out of debt, that's 46% of Americans, and I'm sure there's some overlap on the two of them, that you could improve their optimism, give them some dopamine, make them feel like they have a potential financial future in a world where capitalism is really making things really expensive. And it's not their fault. It's not their fault. Capitalism's got a little out of control, right? If the cost of living to you meet everybody else, the real cost of inflation is 20%, but your wages haven't gone up in the last 2-3 years, well, it's hard not to feel this way. The things you need, the necessities, are cost a whole lot more. Medical visits, childcare. Now you combine some of the elements of, I don't know, returning to work. And you go, okay, wait a minute. In order to return to work, I have to drive my vehicle. So it's either power or gas, depending on what kind of vehicle you have. I've got to get childcare. So that's childcare costs. All these have gone up a whole hell of a lot. And then number three, you got to go, okay, wait a minute. Now I'm sitting in a car for 3-4 hours a day, depending on traffic and how long your commute is. So there's a lot of elements here which make this. So not only did you have a wage inflation piece, right, where wage inflation didn't keep up with the actual cost of living inflation, but you also now have the re-add of return to office costs that weren't part of your life the last couple of years. And humans are very simple. We get used to the lifestyle that we have. And if we get used to the lifestyle that we have, we tend to spend with that as our future mindset. I know families that sold their second car because they're like, we're always together, my wife and I, we only need one car for the family. So, yeah. I don't know if that's the best possible thing at that time, but a lot of people did it. So that was a real thing. Okay. Let's spend a little time going down here. Ooh. There's a rental conversation. There's one from Charlie Bolello. But you know what? It's Friday, kids. It's been a long, long week. The market's been really, really wild. Let's do a little recap here. I don't normally like to go to the indices, but I think today is one of those days where I can justify it. Let's go to the screen share real quick. The Dow Jones Industrial Average is 50,001.36. Wow. 52-week high today. That is sensational. You know, I would not have called that. Let's look at the 5-year chart. Yeah, look at that. 5 years, the Dow. Huh. Would not have called that at all. Let's go over to the homepage here real quick. Let's go over to crypto. Bitcoin's, it's rallying back a little bit, $500 up. Not great, not terrible. Again, I'm very cautious around this. I am not optimistic. We're at a new 52-week low today on crypto, as we all know to start the show. Russell 2K, NASDAQ, S&P all up. The VIX is down. Look at that. It was as high as 19 yesterday. This fear volatility index, people were very much more afraid. Again, these little swings from 19 to 17.9 in this case are meaningful as far as the VIX go. We do have our own synthetic volatility index, which I generally prefer, and this shows to me that risk is getting worse, not better. But we look at a little more of the outside of the consumer sentiment. We look at some of the things that signal it. So we look at realized volatility in the markets, and one of the things we've seen a lot of in the last 24 to 48 hours is real volatility in the markets, in the stock price. Even if it goes up, if that level of volatility, that swing, 1,000 points in stock market today, to me signals risk. This is a synthetic volatility or risk index. Intraday range stress, we're seeing the range on these stocks where they're trading also have some similar challenges there. Cross market volatility seems to be pretty stable because everything across the market that we covered today, at least in the stock market, not crypto, seems to be pretty strong. Even the laggards in the mega caps are still doing kind of mixed reviews for the day, and you're seeing some relatively normal stuff today. So I think our risk profile is actually increasing, despite the fact that it's increasing in a positive way, not decreasing. So that's it for the show today, kids. I think that's been a great one. Let's capture some of the comments and get to see how everybody's feeling. I wanted to give you guys a quick one just because it's been a relatively positive day. We're going into the weekends. Hi, Chris. Hi, Pierre. How you doing? Welcome everybody to the show for the first time viewers. I know there's a lot of people out there on multiple different platforms as part of the joy and the pain of streaming across so many different platforms all at the same time. Let's see who else we got. Wow, lots of comments here. Can we use BTC to buy housing? No, you can't, brother, but you can likely buy your 401k. Crypto bros don't buy houses. I think some of them do. All right, well, I think that's it for today. Let's call it a wrap and let's get it on. And you guys all have a wonderful weekend. Don't forget about Valentine's Day next week. And I will see you guys fresh Monday, hopefully with some optimism of stability in the markets. And we'll see where cryptocurrency is on Monday. If anything, I hope that the Dow and the industrials that support it continue to rally because that's good for Americans and American workers. Until next time, everybody, bye.